Okay, so enough with the doom and gloom, enough with how expensive it is, enough with the insurance companies getting away with all your money. Now let's get on to some of the solutions and then we can get you folks out of here. So, the old style, again, guaranteed renewable means that the premiums can increase and the benefits can decrease. You have to agree to it. But if you don't agree to it, they can just drop you. Again, premature death, or if you just live your full life, but you never need long term care and you just pass away at night in your own house, there's no benefit and they're typically reimbursement. So those policies are very thick, they're very wordy, they're very legal. And so what that means is if you go to Shady Acres because you have dementia and you get tapioca pudding instead of chocolate pudding, somewhere in that contract, it might say, hey, we're only reimbursing for chocolate pudding, but you love tapioca, right? So reimbursement policies, they're like your auto policies where you go get in a bang up car wreck and then you take it to the shop and then the insurance company wants to fight with you. What happened was the two of six activities of daily living. Now, that's a legal definition and it comes from the Internal Revenue Service. What happened was, and why this is a strange part of the world where things got better for consumers, was long term care insurance companies were issuing policies and they said, as soon as you were unable to do two of the six activities of daily living, you qualify for benefits. Well, life insurance companies said, hold the phone, there's a big market out there and that whole part of the market is burning to the ground. What can we do to take on some of this market share? What they did was they took and they created a rider. And that rider has the same legal definition for benefits as traditional long term care insurance. And they created that rider and they simply inserted that language into their life insurance contracts. Life insurance contracts then became a hybrid, part life insurance, part long term care insurance. And life insurance contract, they're what's called non-cancelable, which means once the benefits and the costs are agreed upon by both parties, it's a contract of adhesion, they cannot be changed by either party. The only party that can change it is the policyholder, and the only way you can do that is by stopping payment, and then they're allowed to cancel it. Legally, what it means is the insurance company can't go to the insurance company and ask for a rate increase. They can't send you a letter saying that you have to choose a reduced benefit. So it's so much more advantageous now for consumers. Ironically, again, one of my favorite things is if I'm ever, allocating people's resources, allocating my own resources to my own insurance planning. I don't like paying for insurance any more than anyone else. I do not like it when money goes out the door and I don't get anything for it because of the new hybrid, because it has a death benefit, because of the life insurance component. There's always going to be something coming back to the family. Now, depending on the plan you take or the different product you use, that could be a high death benefit or a low death benefit, or it could be in the form of the long-term care insurance, or it could be a mix of both. That's one of the things that my clients resonate to the most is, okay, well, I'm willing to pay this premium. And man, at some point, either me or my kids or my wife or my husband is going to get some money back. That's a good thing for our overall financial. The new plans can be reimbursement or indemnity. That's really up to your insurance broker to know the difference on which one it is, on what the fine print is. I have 25 different insurance companies that I can go to for any given client, depending on what they need, what they want. It's very, very important to know the insides of those contracts because that could mean the difference between having to fight for tapioca pudding or getting whatever kind of pudding you want. Indemnity policies are the best because the only thing that is required for an indemnity policy to kick in is again that legal definition of two of the six activities of daily living, and then they're mailing you a check. So a good example of this is I have a client in Oregon who, when we think of long-term care, we kind of think that you're stuck in a home or you're unable to care for yourself. Well, this lady is awesome. She's wakes up every day, gets out of bed, makes herself breakfast, and goes and meets her girlfriends for breakfast. The only problem is she can't get into her shower. Well, she couldn't get into her shower. Every time she got in, she would slip and fall. So that's bathing, right? So she checked one box. She was also incontinent. So she had to wear adult diapers, no big deal. So she checked the boxes. She was unable to bathe. She was unable to care for her bathroom needs. So she qualified. So we went to the insurance company, filed a claim, and they mailed her a check for $200,000. And she had wheelchair ramps and a new bathroom put in her with a walk-in tub into her home. So now she gets to spend the rest of her days in her home that she loved because she had an indemnity policy that paid her directly and she used that money for exactly what she wanted. So again, we're going to go over this pretty quick because I just hit most of it. The old style, which is reimbursement, that's just like your auto insurance. They might fight you on it. They might not. Chances are they will. The new style, the hybrid style, Again, that's where you get that indemnity payment, and there's a death benefit and a long-term care benefit, and the full policy is going to pay under one of those two scenarios. Okay, so real quick, I'll just touch on funding and then we'll wrap it up. You can fund these like a traditional insurance policy where you pay a monthly, quarterly, or annual premium. You get qualified medically. Underwriting for the new hybrid style is so much easier than it was for the old policies. The old policies were underwritten on morbidity, meaning they didn't want to write a long-term care policy for someone who was sick or injured or was going to cost them a bunch. That's morbidity. The new policies, because they're grafted onto a life insurance contract, insurance companies don't care really about anything except what's going to kill you. So if you're even moderately healthy, you can qualify for the new style, and the rates are actually much lower and they don't go up over time. And there's a death benefit, et cetera, et cetera. That's one really cool feature is that people who were unable to qualify before now are able to qualify for the new hybrid style. You can have things like inflation protection built in for cost of living adjustment, that type of thing. And another great thing is that the benefits a lot of times are tax free. So if you have a $500,000 policy and you need to advance $200,000 for your long-term care, depending on the IRS limits at the time, that potentially could all be tax free. So, and that includes any growth. So if you paid $100,000 for a $200,000 policy and you drain all that money out, you could potentially be getting away with reducing your taxes on that growth that you're then using for your long-term care. Last couple slides, and then we'll wrap it up. This is just an example of a premium payment method. This is a really great product. This 60-year-old female would have paid $9,200 for 10 years. So paid a total of $92,000 into the policy. So again, we typically set these up to stop paying once people retire because you don't want to be paying a bunch of money for insurance when you retire. This lady had a $400,000 benefit. So she paid in $92,000. She had a $400,000 benefit. The second part of this was the long-term care portion, which said if she went into long-term care, it was going to pay $96,000 a year for 4.2 years. So there's your $400,000 benefit. So as a financial advisor, as much as financial advisors love to hear themselves talk about investments in the stock market, if I would have asked this client to give me $9,200 for 10 years, could I have turned it into a $400,000 benefit? Potentially. With the risk to reward and the guarantees built into these, was I much more comfortable having just her pay an insurance company? Absolutely. And then this one actually has an income rider on it, where if she outlived and didn't need the long-term care, it was going to pay her $400,000 back in income tax-free later on in life. So very creative once again. And again, my favorite part is that these days it's kind of a no loss scenario. The other way that I pay for these is called asset based. So if we come back here, usually when I'm just doing like a portfolio review, a financial diagnostic is what I do in my company. I take a look at taxes and volatility and inflation and fees and the whole nine yards. It is surprising how many people have a lot of money sitting in buckets that is going to sit there till they die and not provide very much benefit. So we're talking about checking accounts, savings accounts, certificate deposits, even bonds. I was just working with a lady who's at Merrill Lynch and they have $2 million. And I looked at the statement and I said, well, you got about $700,000 that's just sitting here, and bonds have gone down 20% in the last. So what are we doing, right? So we elected, it just made sense to move that conservative money out, reallocate it to this solution. So that's called asset based. We just take a look at the accumulated assets. And on average, people who are approaching retirement typically have a lot of their net worth tied up in just very, not Bitcoin, in very conservative assets. So a lot of times paying for these things seems kind of scary, but really when I describe it and I talk to it with my clients about, just consider your money is just sitting in buckets. This money is in a non-risk bucket. So all we do is take money from one bucket and then we hand it to an insurance company and we have another bucket of money going. It's just serving a different purpose, growing in a different way. So this is an example of that. Had a client was about 55. We just took $155,000 out of their conservative bucket. I have a client down in Tacoma. He's older and he has $300,000 sitting in Bank of America. And his comment to me was, I make nothing. He said, I make nothing. I haven't touched a penny. I'm not going to touch a penny. Can I just use that money? And I said, sure, just write a check. This client right here was going to parlay that $155,000 into about $840,000 over 20 years in long-term care, right? Probably they would not need it until they were 84 years old. So really what we were doing is taking $155,000 and just offboarding it, putting it in another bucket And eventually we completely solve this client's long-term care need. So these two are medically underwritten. There's even some fixed indexed products out there that are non-medically underwritten. I showed this option to that same client, $155,000, would grow up with the stock market when the stock market's good, lock in the gains. They never had to worry about market volatility. They could have walked away with all that money and if they have ever wanted it. After 30 years, again, 5 payments of $200,000 is another $1 million benefit. So those are the different numbers behind long-term care, the technical legal definitions of long-term care, and how to address the need for the long-term care to make sure that all those needs get taking care of ourselves, taking care of our spouses, making sure we don't burden our kids. So that's going to be it for the webinar.